What's up, Frost fam? Today we're breaking down one of the most popular option strategies in the market, the covered call. This is how stock investors generate income from shares they already own, and it's one of the few option strategies that even conservative investors use. We're going to show you exactly how to set one up on Charles Schwab step by step in plain English. Let's go. So what exactly is a covered call? Simple version, you own at least 100 shares of a stock. You sell someone else the right to buy those shares from you at a set price called the strike price before a set date. In exchange, they pay you cash up front. That cash is called the premium, and it hits your account the same day you sell the contract. You keep that premium no matter what happens. Why do investors sell covered calls? 3 reasons. 1. You generate income on a stock you're already holding. 2. The premium you collect lowers your effective cost basis on the stock. 3. It's a defined strategy with no surprise risk beyond what you already carry by owning the stock. The risk is that your stock gets called away if it rises above the strike price. We'll cover that in a minute. What you need before you can sell a covered call on Schwab. First, you need at least 100 shares of the stock. One options contract controls exactly 100 shares. Second, you need Schwab to approve you for options trading. When you log in, go to your account, look for options trading approval and apply for level 1 or level 2. Schwab approves most investors for covered calls quickly because it's a conservative strategy. Step 1. Log into schwab.com and go to the Trade tab at the top of the page. Click on Options. If you use the Schwab mobile app, tap the Trade button, then select Options from the Order Type dropdown. You'll see your account, and you'll search for the stock you want to sell the call against. This is the stock you already own the shares in. Step 2. Search for your stock and open the options chain. An options chain is a list of all available contracts sorted by expiration date and strike price. You'll see 2 columns, calls on the left, puts on the right. We're selling a call, so we focus on the left side. Each row is a different strike price, and each tab across the top is a different expiration date. Step 3. Choose your expiration date. The sweet spot for selling covered calls is 30 to 45 days out. This is where time decay, called theta, works fastest in your favor. The option loses value every single day just from time passing, and that benefits you as the seller. Going shorter than 30 days gives you less premium. Going longer than 60 days ties up your shares too long. 30 to 45 days is the professional standard. Step 4. Choose your strike price. This is the price at which you agree to sell your shares if the buyer exercises the contract. If you want to keep your shares and just collect the premium, go 5 to 10% above the current stock price. This is called out of the money. Example: stock at $100. Sell the $110 call. If you're okay selling the shares, go right at the current price for maximum premium. That's called at the money. Here's a real example to make this concrete. Say you own 100 shares of a stock trading at $100. You sell one covered call at the 110 strike, 30 days out, and collect $400 in premium. That $400 hits your account today. If the stock stays under 110 at expiration, the option expires worthless and you keep your shares and the $400. If it goes above 110, your shares get sold at 110, but you still keep the $400. Your effective sell price is $114. Step 5. When you click on the strike price you want, a trade ticket will open. The action should say sell to open, not buy to open. Sell to open. This is critical. Sell to open means you're creating a new short call position against your shares. For the order type, use a limit order, not a market order. A limit order lets you set the exact price you'll accept for the contract. Step 6. Set your limit price. When you open the options chain, you'll see a bid price and an ask price for every contract. The bid is what buyers will pay right now. The ask is what sellers are asking. Start your limit order at the midpoint between bid and ask. For example, if the bid is $3.90 and the ask is $4.10, enter $4 even as your limit. Schwab will usually fill you at or near the mid within a few minutes during market hours. Step 7. Review your order before you confirm. Make sure it says sell to open, the correct strike, the correct expiration, one contract for every 100 shares you own, and your limit price. Click preview order, double-check everything, then click place order. The premium will credit to your account the same trading day, usually within a few minutes of the fill. Now let's talk about max profit, max loss, and when things go wrong. Max profit is the premium you collected, period. You collect it up front and you keep it no matter what. Max loss is the stock dropping to zero minus the premium you collected. That's the same risk you had from just owning the stock. The covered call doesn't protect you from a big drop. What it does is give you some cushion. If you paid $90 per share and collected $4 in premium, your effective cost basis is $86. When should you close the position early instead of waiting for expiration? The professional standard is the 50% rule. If the option has lost 50% of its value, buy it back and close the trade. You locked in half the max profit in less than half the time, and you free up your shares to sell another covered call. Never let a profitable covered call turn into a problem by holding it too long. Take the 50% win and move on. When should you not sell a covered call? If you're extremely bullish on the stock and expect a big run, a covered call caps your upside at the strike price. If the stock rockets past your strike, your shares get called away and you miss the extra gains. So this is a strategy for stocks you're neutral to slightly bullish on, not for your highest conviction momentum plays. Know the trade-off before you enter. Quick recap. A covered call lets you earn income on shares you already own by selling someone the right to buy them at a set price. On Schwab, go to Trade, Options, open the chain for your stock, choose 30 to 45 days out, pick a strike 5 to 10% above the price if you want to keep shares, sell to open at the midpoint limit price, and confirm. Close at 50% profit and repeat monthly. This is not financial advice. Do your own research and never trade options without fully understanding the risk. 3 rules every trade needs. Number 1, a target. Know where you're taking profit before you ever enter. Number 2, a stop loss. Know where you're wrong and honor it. Number 3, time is your friend. The best trades come to you, so don't force it. Let it come. Position sizing. Never risk more than 1% of your account per trade. Set your stop the moment you enter. This is not financial advice. Educational content only. Do your own research. Trade at your own risk. And remember this one. It's not about timing the market. It's time in the market. Nobody calls the top. Nobody calls the bottom. The people who win are the ones who stayed. If you guys like this content, follow, subscribe, throw me something in the comments. I'm here to help you guys. Happy trading, happy investing. I'm live every weekday at 9:30 Eastern. Come hang out.